Hello, welcome to Economics 232. This is a video quiz for chapters 7 through 9. We do all these chapters together, so I'm making a video quiz for them. 10 was a little bit too long, so I'll do 10 later. All right, the first thing that we're going to talk about, if I can get this to work, there we go, is cost curves, and this comes from chapter 7. The first thing that we talk about is a basic assumption in mainstream economics, and that is that businesses are engaged in profit maximization. Every single decision that a business will make is made under the assumption that they will choose that choice which maximizes their economic profit. Now, one thing to remember is that this is an assumption, and this is not how the real world works. Oftentimes, businessmen will not make decisions that maximize profits, but we assume that they do. Okay? Now, when we talk about profit, we have to distinguish between the way economists measure cost and the way that accountants measure cost. Accountants and economists both measure cost, and we both include explicit costs. These are payments to non-owners of a firm for their resources. So if you pay wages to labor, that is an explicit cost because you're using the labor of a non-owner of the firm, so you have to pay them. Typically, you can think of explicit costs as anything you write a check for. Rent would be an explicit cost if you have a landlord. Okay. Now, if you own the building, then there is no check that goes out. So it does not count as an explicit cost if you own the building. A worker, his costs are explicit costs. The owners of the firm, because if he doesn't pay himself a salary, those are not explicit costs. Those are the things that accountants count because they can be counted. Economists also include what we call implicit cost. And this is the opportunity cost of using resources owned by the firm. So for example, if a owner works in his own company, okay, an accountant, and he doesn't pay himself a wage, an accountant would not count that as a cost, but an economist would. And the way we would count it is we would look at the opportunity cost of his labor. What is the next best option for the owner's labor? And let's say he could get a job working for $50,000 a year or run his own business. The implicit cost of him using the labor within the business is the $50,000 a year salary that he foregoes. If a business owner owns the building, he doesn't pay himself rent, so that does not become an explicit cost. An accountant would not count the value of the services of the building. An economist would, in that we would say, well, if he didn't use the building in his own business, he could rent it out for $5,000 a month. So that $5,000 a month is an implicit cost to using the building in the business. Total opportunity costs, what we count as economists, are explicit plus implicit costs. Those are both counted by economists. Accountants only count explicit costs because there's receipts or checks that they can count, but they do not oftentimes count implicit costs because there's no check or a receipt to count. Economic profit is total revenue, that's price times quantity, that's the total amount of money the business brings in, minus explicit and implicit cost, or total revenue minus total opportunity cost. We differ from accountants. They don't subtract out implicit costs. So an accounting profit is different from an economic profit. Economic profits are what businessmen operate on. Now, a normal economic profit, or a normal profit, is the minimum profit necessary to keep a business in operation. and that becomes a zero, that is a zero economic profit. So think about it. Let's say I work in my own business. I run the business and I make $50,000 profit that I get to keep. That would be a normal profit because, for example, $50,000 in accounting profits. Okay, that's what I earn by keeping the business open. If I shut the business down, I'd have to take that job at $50,000 a year. There's no difference there between owning my own business and the amount of profit I'd make, accounting profit, and the salary I'd make. So my economic profit is exactly equal to zero. It's equal to my accounting profit of the $50,000 minus the explicit cost of $50,000 I could make by working for someone else. So my economic profit would be zero, and that would be just enough to keep the business in operation. Anything less than that, I could make more by shutting my business down and going to work at $50,000 a year. A firm that earns normal profits earns total revenue equal to its total opportunity cost, and that is a zero economic profit. Okay. Accounting profits are different. That's total revenue minus explicit costs, but we don't subtract out those implicit costs when we're talking about an accounting profit. Okay, so here's just an example of what I said. Okay, accounting profit, this firm makes $50,000 in revenue minus $470,000 in explicit costs. They're making a $30,000 accounting profit. But when we look at economic profit, this guy could make $50,000 a year working in another job. He gives up $10,000 a year in rent on the building and $5,000 in interest he could earn on his capital. As in terms of economic profit, this firm is making a negative $35,000. This businessman would be better off shutting down his business, going to work for $50,000, renting the business out for $10,000, and earning $5,000 a year in interest on his capital. So he'd be better off shutting this business down. Economic profit tells us that. Accounting profit does not, because it does not include those implicit costs, only the explicit ones, which we both count. So the conclusion we can make is some business decision making is based, since business decision is based on economic profit rather than accounting profit, the word profit from now on always means economic profit. Now, when a businessman operates, we're looking at his cost here. He has two types of inputs, fixed and variable. A fixed input is any resource for which the quantity cannot change during the period of time under consideration. Okay? So right now, or in the next month, I can't sell my factory. So my factory and all the capital goods in it would be a fixed input. A variable input is any resource for which the quantity can change during the period of time under consideration. Labor, say now or in the next month, would be a variable input because I could lay workers off. I could send workers home early today. So those things I can change under the period of time under consideration. Now, what is that period of time under consideration? We have a short run and a long run. The short run is a period of time so short that there exists at least one fixed input. So let's say I have a 1-year lease on my factory. Okay. If I try to shut my factory down, I still have to pay the money on that lease. I still own the factory. I can't reduce that. So the short run would be, say, that 1-year period where I have the lease. Because during 1 year, I'll always have one fixed input, and that's going to be my factory. The long run is a period of time so long that all inputs are variable. So if I have a 1-year lease on the building, The long run is a period of time greater than a year, say a year and 1 day or anything past that. That would be the long run, because in the long run, after my lease runs out, I can alter all of my factors of production, or my inputs. I can use more or less labor, more or less capital goods, more or less a larger or smaller factory. I can vary all of those things. That's the long run. There are no fixed inputs in the long run. Oftentimes we use something called a production function. And this is a relationship. This is usually an equation that describes the relationship between the maximum amounts of output a firm can produce and various quantities of input. So if we had this production function, we could alter the amount of inputs we use, and it would tell us the maximum amount of output we could produce with those different amounts of input. Okay. Technological advances make more output possible from a given quantity of input. So if I improve my technology with the same amount of land, labor, capital goods, but I improve my technology, with those same land, labor, and capital goods, I can produce more output if I improve my technology. Now, when we look at these production functions, we put a variable input in, say labor, and we assume all the others are fixed, land and capital. Then we alter the amount of labor, and that will tell us how much output we can produce. Now, the amount of output, the change in total output produced by adding 1 unit of a variable input with all other inputs held constant, that is the marginal product. So I hold the land and the labor, the technology, everything else land, capital goods, technology, everything constant. And I only add or subtract 1 unit of labor. The amount that output changes is my marginal product. The law of diminishing returns is a principle that beyond some point, say as we're adding labor to a production process, holding everything else constant, the marginal product of that variable factor, labor, decreases as additional units of a variable resource are added to a fixed factor. So initially, as we add labor, we could get more output per unit, or for that unit as we add it. So maybe we have 0 workers, 0 output. I hire a worker to work in my pizza factory, and he's got to cook, he's got to take the orders, he's got to box the pizza, he's got to make the ingredients, he's got to answer the phone. Maybe he could produce 4 pizzas an hour. Then if I bring a second person in, they're gonna make the ingredients, they're gonna box the pizzas, they're gonna take the orders on the phone, and they're gonna help the customers that come in, and the other guy's just gonna cook the pizzas. In that case, by adding that second unit of labor, maybe we now get 10 total pizzas. The marginal product of that second unit of labor would be the difference between the total product, 10, and the amount of pizzas we had before we added him 4. So 10 minus 4 is 6. By hiring the second worker, we go from 4 to 10 pizzas per hour. By hiring him, we gain 6 pizzas per hour. Maybe the third worker, we hire him. He's going to answer the phone and make the ingredients. The second guy's going to cook, and the third guy's going to box the pizzas and hand them out to customers. There, maybe we could produce 20 pizzas in an hour. We could produce 10 when we had 2 workers, 20 when we have 3. His marginal product is 10. So we've gone from 4 for the first, 6 to the second, 10 to the third. Now, at some point, the law of diminishing returns kicks in. As we hire another unit of labor, say the fourth, we'll get fewer than 10 extra pizzas out of him. So we were producing 20 when we had 4 workers. Now we hire a fifth, and we only get 24 pizzas. The marginal product of that first worker is 24 minus 20, 4 pizzas per hour. That's his marginal product. That's less than the marginal product of the third worker, which was 10. So at that point, we would say the law of diminishing returns kicks in. Okay. Now, the law of returns assumes that we have fixed inputs and is therefore a short-run concept. We could get around it in the long run, say by making a bigger pizza restaurant, bringing in more ovens or more phones or more technology. So in the long run, we can get around that law of returns by increasing our fixed inputs. Here's just another example. This is a vineyard, and here's the amounts of labor they have. 1, 2, 3, 4, 5, 6 workers. Here's how much they produce in terms of bushels of grapes per day. If they had 0 workers, 0. The first worker, we add him. Now we have 10 bushels of grapes per day. 10 minus 0 is 10. So his marginal product is 10 bushels per day. Then we hire a second worker at the vineyard. We had 10, now we have 22 bushels per day. We gained 12 bushels by hiring him. His marginal product is 12 compared to the first worker who's 10. So here the law of returns has not kicked in yet, because as we increase the number of workers, we're increasing their marginal product. Here's where the law of returns does kick in. If we go from 2 and we hire a third worker, we go from 22 bushels of output per day to 33. The marginal product, what we gain by or lose by hiring or firing the third worker, is 11 bushels per day. His marginal product is less than the marginal product of the second worker, so the law of returns kicks in here between 2 and 3 workers. And you can see as we add more and more workers, their marginal product declines. Here's total output. Here's what that marginal product might look like. Okay, and in this case, we go from 0 pizzas to 10 to 1 worker. That gains 10 pizzas. The second worker, we mark these on the half because they're marginal products. So this is actually the marginal product of the first worker, but it's on 1/2. The marginal product of the second worker was 12. There it is. And then the third worker was 11. Now you can see here that curve starts to decrease after the second worker. So we say that the law of returns kicks in after that second worker. You can see we've got that highlighted in magenta there. Isn't that nice? It's pretty. Okay. Here we're just putting the dots in. Marginal product of the second worker, third, fourth, fifth, even though they're marked on the halves. Now, just like we have fixed inputs, we have fixed and variable cost. Fixed costs are costs that do not vary as output varies and that must be paid even if output is 0. For example, rent, interest on loans, and property taxes. Okay, so let's say I'm renting a factory and it costs me $1,000 a month to rent the building. That would be a total fixed cost because I have a 1-year lease and I can't get out of it. Even if I shut the business down and don't produce any output, I still have to pay $1,000 a month. So in that case, $1,000 a month would be my total fixed cost. The next thing, just like variable inputs, we have variable costs. Variable costs are costs that do vary as output increases or varies. Okay, they are 0 when output is 0. So let's say this business I have is a pizza restaurant. Okay, I'm paying $1,000 a month in fixed cost for the next year because I have a 1-year lease on the building. If I produce no pizzas, how much electricity and how much labor am I going to use? 0. So my variable cost at 0 units of output would be 0. Then if I hire one worker at $10 a piece or $10 an hour, my variable cost would go up to $10. If I hire 2 workers for an hour, that's $20 and so forth and so on. Total costs are the sum of total fixed cost and total variable cost at each level of output. So as output expands, my fixed costs will stay the same and my variable costs will increase. And I'm going to add them together at each level of output. You've got to remember this equation. Total cost is equal to total fixed cost and total variable cost. Another way of thinking about this is there are only 2 types of costs, fixed and variable. Average fixed cost is total fixed cost divided by the quantity of output produced. So if, let's say I'm open for 1 hour, I have 1 worker, okay, my variable costs were $10, my fixed costs are $1,000. My average fixed cost would be the $1,000 divided by the 4 pizzas I produced. That would be $250 per pizza. If I'm producing 4 pizzas. To produce 4 pizzas, I have to pay my worker $10 to work that hour. Total variable cost of $10 divided by the quantity of output, the 4 pizzas I produce, will give me my average variable cost. So my total variable costs were 10. I divide that by the 4 pizzas I produce. At an output of 4 pizzas, my average variable costs are $2.50 per pizza. Average variable costs are equal to total variable cost divided by your output. Now, average total cost is total cost divided by the quantity of output produced, also called the per unit cost. So here, I produced 4 pizzas. I had $1,000 in fixed costs plus $10 in variable cost. If you divide $1,010 by 4, you will get $252.50. That would be my average total cost. We could do it that way, or we could have said average total cost is equal to the average fixed cost, which if you go back a couple slides we said was $250. Plus our average variable cost of $10 divided by 4 pizzas, that was $2.50. So I can get my average total cost of $252.50 this way or that way. You'll come up with the same answer. The next thing is marginal cost. And marginal cost is the change in total cost when 1 unit of output is produced. And it is equal to the change in total cost divided by the change in output. Now, the nice thing about this is we're always using 1 unit changes, so this is always 1. So let's say it cost me $1,010 to produce 4 pizzas. If I wanted to produce 5 pizzas, it might cost me $1,015. So dividing $1,015 by 5 pizzas, I would get a $205 marginal cost. So the cost of producing that 5th pizza, So I got 1,010 to produce 4 pizzas and 1,015. If I subtract 110 from 115, my change in total cost is $5. The change in output 5 pizzas minus 4, and it's always going to be 1 in our examples is 1. So 5 over 1 is my marginal cost. To produce 1 extra pizza, in that case, would cost me $5. Now here we've got another example of a firm. Okay, this firm has $100 in fixed costs. If you'll look, fixed costs never change with output, never. It's always 100, whether I produce 0 units of output, 12, or 1,000,000. Variable cost changes my output changes. So if I go from 0 to 1 unit of output, my variable costs increase by 50 from 0 to 50. If I go to 2 outputs, my variable costs increase from 50 to 84. Now the change in total cost is going to be change in total cost is going to be the same as the change in the variable cost. So you see here, by producing 1 unit of output, I go from $100 in total cost to $150. The change in total cost is $50 over the change in output, which is 1. That produces a marginal cost of $50. My average fixed cost is my total fixed cost at 1 unit of output divided by 1 pizza. That's $100. My average variable costs are my total variable cost for 1 pizza divided by 1 pizza. They're $50. And then my average total cost is $150 in total cost, fixed plus variable, divided by 1 pizza. They're $150. Now, when I go to producing 2 pizzas, you can see here my variable cost and my total cost increase by $34 when I produce that second pizza. That's my marginal cost. That's what it costs me to produce that second pizza. Now, when I increase the number of pizzas I produce, my fixed costs stay the same. It's still at 100. But now I'm dividing that up amongst 2 pizzas instead of 1. So here, my average fixed cost is 100 divided by 2 pizzas, $50 per pizza. My variable cost, my average variable cost is equal to my total variable cost of 84 divided by the 2 pizzas I produce. So that's going to be $42. We can add average fixed and average variable together to get average total cost of $92. And you can see we go here, so forth and so on. If you want to look at this more, pause the video and you can look through and go through all the examples, and it'll help you understand how we calculate these marginal cost, average fixed cost, average variable cost, and average total cost amounts at each unit of output. But I'm going to go on. Now, here we have a short run cost curve for a firm. This first curve, the blue curve, is my total variable cost as I produce more units of output. The green curve is my total cost curve. And the difference between these two is always my total fixed cost, which in our little example was $100. Okay, there's total fixed cost. The distance here should be equal to the distance between the blue and the green curve, because total cost is nothing more than total fixed cost with this, total variable cost at that amount of output with this total fixed curve on top of it, or the amount of it. Okay. Now this is the interesting part, and this is what we really want to focus on, and this is the short run cost curve. The first curve you want to focus on is this marginal cost curve. Here you can see, in this case, marginal cost increase as output increases. So we have output on the x-axis, cost per unit or dollars on the y. As I increase my output, as I move to the right, marginal costs decrease until I get to some point. Say this looks like 3 units of output. This bottom point of the marginal cost curve corresponds to the amount of output we produce when we're at the top of the marginal product curve, where the law of returns kicks in. After that, I use more labor per pizza or more labor per unit of output because of the law of diminishing returns, and my marginal costs start to increase. Marginal costs are typically drawn as sort of a slanted J. You can see a slanted J. On the next slide, I'm going to make all these curves a different color. The other basic curve we know about is this average fixed cost curve. Average fixed costs start at 100 for 1 unit of output and decrease as we produce more output. This curve continues to decrease and asymptotically approaches zero. It gets smaller and smaller, but it never actually gets to zero. The next curve we're going to look at is this dark blue average variable cost. Average variable costs start off high and decrease, and they reach a minimum point. Average variable cost is at its lowest, where the marginal cost curve, this red one, the slanted J, crosses or intersects the average variable cost curve. At this point, average variable costs are at their lowest point. Where marginal cost is above average cost, average variable cost increases. So we get this nice little bowl shape here. Okay. This curve right here, average total cost, the green curve, is equal to my average fixed cost at some unit of output, say 6, plus my average fixed cost curve. So if I could take this distance and move up that amount from the blue average variable cost curve, that would be my average total cost. The difference between the two curves, the green and the blue, the average total cost and the average variable cost, is always equal to the average fixed cost below it. As this asymptotically approaches zero, this average total cost curve approaches but never touches the average variable cost, because the difference between them continues to get smaller and smaller as we increase output. Now, this point right here, where the marginal cost curve crosses, the average total cost curve, that is where average total cost is at its lowest. After that, we're adding more to cost than the average, so it's going to start going up. This point right here, where these two curves cross, average total cost and marginal cost cross, that is called, the break-even point. Where these two cross, that's where the firm breaks even. If we go straight across here, say that would be about $44. This does call it $42. These two intersect at a cost of $42. If the firm receives an average revenue from each unit of output more than $42 at this point, that firm will make a profit. This point here, where marginal cross, that slanted J again, crosses the average variable cost curve, that is called the shutdown point. If the price the firm receives is above, we'll call that 31, above the shutdown price, which is determined where these two curves cross, you go straight across, any price above there, the firm can cover all of its variable cost and some of its fixed cost. If that's the case, that firm will be suffering a loss if the price is below the break-even point, but they're covering, say, a price here at 35, they're covering all of their variable costs, and they have some extra left over to apply to their fixed cost. So this firm will be maximizing its profit through minimizing its loss by staying open rather than shutting down. If they shut down, they'd have to pay the full $100 in fixed cost. But if we're at a price at or above this point, we can cover all the variable cost and then maybe some of the fixed costs, say $20. So then by staying open, we only have to pay $80 of the fixed cost out of our pocket. We lose $80 a month by staying open. But if we shut down, we'd have no fixed costs but no revenue, and we'd have to pay the full $100 a month in variable cost. Any price below this shutdown point, say down here at $20, the firm will shut down immediately in the short run and the long run. And that's because any price below this $31, the firm, for every unit of output it produces, has to pay some of those variable costs plus all of the fixed cost every month. If they just shut down, variable costs are zero, and all they would have to do is pay the $100 a month in fixed cost. Study the shapes, especially of these four curves. You'll need to know them. I might have a question on an exam or a quiz where I say, I may not have the name of it. I say, what's this curve? What's this curve? What's this one? What's that one? We know that's marginal cost. It's got a slanted J shape. Average fixed cost, this is decreasing as output increases and asymptotically approaches the x-axis or zero. Average variable costs have that nice smooth bowl shape, and average total costs are average fixed cost plus average variable cost. And it's got a bowl shape, a little bit more exaggerated in this case. Okay. You can read the average marginal rule. When marginal cost less than average cost falls. When marginal cost is greater than average cost rises. When marginal cost is equal to average cost, the curve is flat, in this case only at one point, and average costs are at their minimum. This also works for average variable costs. Okay, we've discussed this, but the rising portion of the marginal product curve corresponds to the declining portion of the marginal cost curve. That's that slanted J curve. So as that curve is decreasing, that is over the rising portion of the marginal product curve. Once marginal costs reach the bottom of the J and start to increase, that's where the law of returns kicks in. That's where the marginal product curve is actually decreasing. Okay. Here's what I just said, and I'll give you a picture of it in just a second. Okay, you can see here, that's where my marginal product curve starts to decrease. Marginal product is at its maximum where marginal cost is at its minimum. Now, we'll take a short quiz and then we'll come back. Hope you enjoyed the quiz. Now, I've just drawn those marginal, those cost curves for the firm here, and I've got them in different colors. I left out the marginal, the average fixed cost curve, but that's that one that decreases. Here you can see in yellow, that's the marginal cost curve. Average variable cost curve in blue. Average total cost curve in green. There's my shutdown point. There's my break-even point. Now, one of the interesting things here is that in neoclassical economics, the supply curve is the marginal cost curve. Excuse me, I gotta go back. Sorry about that. Is the marginal cost curve above the shutdown point. So this whole section here of that marginal cost curve, that becomes the firm's supply curve for a firm. So above this bottom light blue average variable cost curve, that bowl-shaped curve, the rest of this marginal cost curve becomes the firm's supply curve. As we increase output, the marginal cost of producing output increases. That's why we had the law of increasing opportunity costs, or in this case, increasing marginal costs. As output increases, the cost of each additional unit produced increases. That's its marginal cost. Okay? Now, one thing to remember before we go on to this next slide here. All firms are profit maximizers. Okay? Now, we take those cost curves, and that is what represents the firm in neoclassical economics. That's how they represent the firm, is with those cost curves. Okay? Now, if we've used all that to get the supply curve, what do we need? A demand curve. This is where chapters 8, 9, and 10 come in. We've got our cost curves, that's the firm, and that's the supply curve for the firm. That's different than the supply curve for the industry, if you'll remember, or the market. That is a collection of all of those individual supply curves from each firm. So here, we need to know what is demand. Now, the way that demand affects the firm differs in neoclassical economics based upon the type of market they're in. The first type of market we're going to look at is what we call perfect competition. Okay? Perfect competition is a special type of market. And in perfect competition, market demand and market supply curves determine the price that a perfectly competitive firm faces, and thus that becomes its demand curve. So when we look at a perfectly competitive market, we want to look at the market supply and demand curves first. So this might be the market demand curve for pizzas, say in Gadsden. Here's the supply curve, the market supply curve for pizza. All of those little supply curves for each individual firm, and in neoclassical economics, you can assume each firm has the same marginal cost curves. So if we add up these supply curves for all the firms in the market, like we did in chapter 3, that will give us this market supply curve. And here, if we add up all the individual demand curves for pizza in the Gadsden area, that would be market demand. Where those two curves intersect in a perfectly competitive market, that determines the equilibrium price. In a competitive market, all pizzas will be sold at this equilibrium price. And where these two curves intersect, if we go straight down, that determines Q star. This is nothing new that we didn't already learn in chapter 3. Now, where we're adding here is now we're taking that price that all pizzas sell for, going straight across, that becomes our demand curve. In a perfectly competitive market, the firm can sell all of the pizzas it wants at that market price. So this might be $10 a pizza. At a price of $10 a pizza, the firm can sell as much or as little as it wants, and there'll be a buyer for it. And that was determined back here. That price was set on the market at $10. Now, that demand curve is horizontal. And if you remember, I told you in class that a demand curve has to be downward sloping and to the right. This is a violation of the law of demand. They justify it by setting certain conditions in the market. They say that all firms are small, that no one firm, by altering its output, going back here, can change this market equilibrium and alter the price. They say that these firms sell a homogeneous product. In other words, one pizza is just as good as any other. They're viewed as being the same by people. Now, this might be for regular pizzas. A gourmet pizza would be a different market. And we say that there is very easy entry and exit into this industry. There are no barriers to entering or leaving the industry. If that's the case in neoclassical economics, they think it's okay to violate the law of demand and have this horizontal demand curve. Now, demand is equal to price, okay? No matter what X is, no matter what Q is in this case, Y, or price in this case, doesn't change. So demand equal to P is the equation for this line. Now, marginal revenue is the change in total revenue divided by the change in output. If every pizza sells at $10 and I increase my output by one pizza, my revenue will change by $10 as well. I'll just sell another pizza at 10. So marginal revenue is equal to price, and so is average revenue. Average revenue is the total revenue I make from selling a pizza, P times Q, minus P times Q minus 1. If P is the same, and we go from, say, 10 to 9 pizzas, price is always $10. At 10 units of output, we'll sell $100 in pizzas. At 9 units of output, 9 times $10 is $90. We'll sell $90 in pizzas. So you take 100 minus 90 over 10 minus 9 pizzas, which is one pizza. Average revenue is always equal to the price of $10. So these three things are always equal only when you have a horizontal demand curve. And you only have a horizontal demand curve in a perfectly competitive market, and that applies only to the firms in that market. They can sell as much or as little of their pizzas as they want at a price of $10, so that becomes the demand curve, D equals P. No matter how many pizzas they sell, they'll always get an additional $10 for selling the next one. So marginal revenue is 10 and average revenue is 10. Now here, if average revenue, which is equal to demand, say here at D1, is greater than average total cost, so if the firm is operating here at D1, they're going to operate up to the point where marginal revenue equals marginal cost. For perfectly competitive markets only, the demand curve is the marginal revenue curve. So where it crosses the marginal cost curve, that would determine how much output the firm is going to produce. And they'll sell it at this higher P star. If we take that same amount of output, trace it down to the average total cost curve, this might be $15. Trace that down here, that might be 11. So every pizza I make, I sell at $15. On average, I'm spending $11 a pizza to make them. I'd be making a profit of 15 minus 11, or $4 per pizza. Now that's an economic profit. If I make an economic profit, and all firms in this industry would because they have the same demand and marginal cost curves, then that would attract other firms into the industry. Because it's very easy to enter this industry. A hamburger store could convert over to a pizza store, or people could start up their own pizza stores. These people are making an above market profit that's going to attract new entrants into the industry. As that happens, if we go back here, that would increase our market supply, driving the price that these firms take for their pizzas down. So as firms enter the industry, demand decreases from D1 to D2. So as firms enter the industry because of these above market profits, that's going to drive the price down because the supply in the industry will increase. And as supply drives down, that'll decrease the price, and it'll move us back to this point here. At this point here, all firms in the industry are making what we call a zero economic profit. They're just breaking even. So as firms enter the industry, they compete this economic profit away until you get back down to this break-even point or a zero economic profit, or what we called a normal profit earlier. That's just enough to keep the firm in the industry. So here, firms will stop entering the industry because there's no above market profits to be earned. The next slide here, we've got a firm suffering a loss. They're operating down here at D1, and that says at D2, but that should be D1, this bottom curve. Okay, now this curve is the marginal revenue curve for the firm, where marginal revenue crosses marginal cost. That determines, how much output this firm will produce. So this firm will stay open in the short run because they're making a profit. They're not making a profit. They're suffering a loss, but they're making more than their average variable cost at that output. This difference, say that was $1 multiplied by the number of units they produce, that money could be applied to paying their fixed cost every month. So they would be better off staying open because that will minimize their loss. As firms lose in an industry, some firms will leave that industry and go into profit-making industries in the neoclassical model. As firms leave the industry, that's going to decrease market supply, and as you can see, that will drive the price up in the market. So we go back here. As price increases, right, as we increase price, firms will start to make more, charge a higher price for their output. Firms will continue to leave the industry until we get back to this point where the firms are earning a zero economic profit, the same point back here. In this case, no firms will be making losses anymore. All firms in the industry will be making a normal economic profit, and there's no reason for them to leave or for other firms to enter the industry. So in the long run, all perfectly competitive firms make a zero economic profit. It is impossible for them in this model to make an economic profit. They all break even. They do not make an economic profit. So once again, here are the 4 different possible cases. D1, that firm's making a profit. In this case, it's going to stay open in the short run and the long run because you're making an economic profit. You're making more than other industries are in other markets. So you're going to stay in this market and you're going to stay open. Then here at D2, that firm is just breaking even. So all firms will make a zero economic profit. There's no reason for a firm to enter this industry because they won't make any more money than they made in another one. There's no reason for a firm to leave this industry for another because they won't make any more money in that industry. Everyone will be making this normal economic profit. Down here, this firm right here, D3, this firm is suffering a loss. They're operating below the break-even point, but they're getting a price above the shutdown point. So this firm will stay open in the short run and shut down in the long run, say after their lease is up, and they no longer have to pay those fixed costs. They stay open because the price they're receiving is above the average variable cost. So they cover all of their variable costs, plus they have some of this money left over to apply to fixed costs. If they shut down in the short run, they'd have to pay all the fixed costs, so they're going to stay open. If you ever see a store that says, maybe has a going out of business sale, Okay, they're anticipating going out of business when their lease runs out, but they're going to stay open in the short run to try and cover all of their variable costs plus some of those fixed costs so they don't have to pay the full lease. And then finally, we have a firm operating with a demand curve of D4 here. The price this firm is receiving at D4 is less than the shutdown point price. This firm will shut down in the long run and the short run because they're receiving a price less than their average variable cost. So if they were to stay open and produce output, they would not have enough money to cover their variable costs, so they have to pay those, some of those, plus the fixed cost. If I just shut down, all I have to pay are fixed costs because variable costs are zero if I'm shut down and producing zero amount of output. So those are the four cases. D1, we're making a profit, stay open in the long run and the short run. And that's because the price we're receiving is above the break-even point. We're making a profit. That's what we want to do. D2, we're operating at a normal economic profit right at the break-even point. There's no incentive to leave the industry or for another firm to enter it. That's where the firm operates. All firms operate in the long run in perfectly competitive markets. D3, this firm will stay open in the short run and shut down in the long run. And then D4, this firm will shut down in the long run and the short run. You should know these. Okay. Next thing we have is a monopoly. Okay, welcome back from the quiz. The next thing we're going to talk about is what is a monopoly? Okay, what is a monopoly? Okay, a monopoly is a market structure characterized by a single seller. This is in contrast to perfect competition, where we had many small sellers. Here we have one single seller. They are selling a unique product. With perfect competition, they were selling a homogeneous product. A unique product means there are no close substitutes, say like electrical power to your house. Number 3, impossible entry. You cannot enter this market. This would be in contrast to perfect competition, where you had very easy entry into the market. Okay, a monopoly is what we call a price maker versus a perfectly competitive firm, which is a price taker. The market supply and demand curves determine the price that a perfectly competitive firm had to take. Here, a monopoly means when we say price maker, it doesn't mean they can make any price they want, but rather that they face a downward sloping demand curve instead of a horizontal one. Okay. The unique products, there's no close substitutes. Okay. Barriers to entry, ownership of a vital resource. This has almost never happened. The book points to Alcoa, which was an American aluminum company, and they had a large control of bauxite, but not all of it. Okay, a legal barrier to entry. Here's where the government says no one else can produce this good. Alabama Power has a legal monopoly, a legal barrier to entry by anyone else. Only Alabama Power can supply power to your house if you live in the city of Gadsden. Comcast Cable is the only cable provider. There are legal barriers. The city will not let anyone else provide those services. Or economies of scale, which we'll look at later. Economies of scale, oftentimes because of economies of scale, a single firm in an industry will produce output at a lower per unit cost than 2 or more firms. Okay. Now, monopolies are price makers. All that means is that they face a downward sloping demand curve. As a result, a monopoly can choose its price along the demand curve. So here we have a demand curve. Now, monopoly, I only have one graph, and that's because the monopoly is the market. The monopolist faces the market demand curve. And because that demand curve is downward sloping and to the right, to sell more output, as we move to the right, they have to lower the price so that consumers will buy that product. As a result, marginal revenue is not equal to price. This purple curve here is the marginal revenue curve. Here we have the same types of cost curves that we have for other firms. Here's your marginal cost curve. Now, the important point is right here. That point right there where marginal revenue, the purple curve, crosses the orange marginal cost curve, that is where a firm maximizes its profits. All, not just monopolies, but all profit maximizing firms will produce output to the point where marginal revenue equals marginal cost. That determines how much output they'll produce, Q star for the monopolist. If we take that quantity, which we got from where the marginal revenue curve equals marginal cost, where they cross, and we take that quantity, we go up to the demand curve, that determines the price that a monopolist will charge. So they'll charge this price and they'll sell this much output. Now, a monopolist in this model can make a long-run economic profit because there is impossible entry into the market. This particular firm, here's the price they charge. They charge that price for all units of a good. And if we trace the quantity up to the average total cost is down here. Price is equal to average revenue. So maybe they're charging $20 a piece for this output, but it's only costing them $10 to produce that amount of output on average. So this firm is making an economic profit. Now, in a perfectly competitive market, other firms could enter the market that would reduce demand, lowering the price, bringing them down to the break-even point. But here, no other firm can enter this industry because of, either they own all of a vital resource, they're legally prevented from doing so, or economies of scale prevent them from doing it. So in that case, this economic profit does not get competed away and can last. Now, just because a monopolist can make a long-run economic profit doesn't mean that they will. Okay? This profit is what the neoclassicals call a rent, and outside interests can compete away that rent. Let's say that we're giving this company a legal monopoly. Politicians might extract bribes, which would raise these cost curves up and reduce that profit. They might have labor, which might unionize and say, hey, we want some of that rent. And that would raise their cost. Okay? Or suppliers might hold them up and say, hey, we're not going to supply you unless you give us a higher price for our product, for the supplies, and that can raise costs up for the monopolists. Some monopolists can actually suffer a loss. And that is the end of this slideshow presentation. I hope you enjoyed it. There will be a short quiz, and then we'll be done. Thank you.